The world is quiet right now, too quiet. If you are waiting for the mainstream narrative to kick in, for the headlines to start screaming about what happened last week, then you have already missed the point. This isn't a truce. It is the silence that follows a decisive, brutal battle, a war fought not in the daily volatility, but on the unforgiving geometry of the weekly chart. We are witnessing the final, brutal surrender of the institutional forces, the multi-trillion-dollar banking cabal, and central planners who have spent 2 centuries trying to manage and suppress this market. Their objective was always simple: maintain the illusion of control. Their failure is now complete. The axis of this battle is clear: the forces of unlimited paper liquidity versus the immutable laws of physical scarcity. Forget the daily noise. The only thing that mattered last Friday was the weekly candle close. That candle is not just a data point, it is a final verdict. When that final bell rang at $65.77, we didn't just tick up. We closed with a solid Maribozu*. For the non-technicians, that means the buyers were in absolute, uninterrupted control from open to close. The candle shows 0 upper wick, indicating every attempted sell-off was immediately absorbed and reversed. We didn't just challenge the $65 critical resistance line. We broke it, annihilated it, and instantly turned it into the new high-friction floor. For decades, the standard playbook was simple. Friday afternoon, smash the price, scare everyone out of their positions, and confirm the institutional narrative of suppression. But this time, the historic Friday smash failed to materialize. It failed because the variables have changed fundamentally. The difference is simple, yet profound. The paper market is running out of physical supply. You cannot suppress an asset when the manipulation mechanism relies on inventory that is rapidly dwindling. The precedent has been shattered. The price is no longer driven by derivatives. It is being driven by the reality of depletion. If you held your ground through this last wave of manipulation, you have passed the primary psychological test. You are no longer trading based on hope. You are trading based on mathematical and fundamental conviction. This is the exact moment where our entire framework pivots. We are no longer participating in a cyclical rally that fades after a few months. We are now investors in a structural, multi-year supercycle. The market has rejected the trap. Look at the chart right now. What you see is not a ceiling, or simply resistance. It is a textbook bull flag, a massive consolidation pattern that has been winding up for months. Think of it as a spring, coiled tighter and tighter, absorbing every last attempt by the institutions to inject fear. The potential energy stored in this pattern is absolutely monumental. And the moment that spring is released, the initial movement will not be slow, cautious, or voluntary. It will be fast, it will be brutal, and it will be completely automated. It will be fast, it will be brutal, and it will be completely automated. Because the great institutional money managers, the ones who control hundreds of billions in passive capital, do not operate on hope or fear. They operate on cold, clinical math. They are trend followers. Their primary rule is simple: if the market closes above a major, established resistance level, you execute the buy order immediately. They don't care about geopolitics, interest rates, or fundamental news. They only care about geometry. That $65 line, which has been the institutional battleground for weeks, is not just a resistance point, it is the algorithmic gate. When that gate is breached, passive capital, through massive ETF flows and managed futures funds, is forced to pile in. We are talking about billions of dollars programmed to execute a single, simultaneous instruction. We've already navigated and benefited from the first 2 waves of buying. Wave 1 was the retail speculator, buying on rumor and optimism months ago. Wave 2 was the industrial player, the manufacturers and sovereign funds, buying because they know the physical supply crisis is real and getting worse. But the third wave, the true artillery, is the institutional trend follower. They are the ones who solidify the move, transforming a cyclical bounce into a sustained structural supercycle. When they enter the market, you move from a strong rally driven by psychology to an undeniable, self-sustaining shift driven by mathematics. This is the difference between a skirmish and a full-scale invasion. Now, we must address the critical transition: managing the weekend. Traditionally, a weekend pause feels like maximum risk, but we are in a completely inverted risk environment. Right now, the risk is not holding this appreciating asset. The risk is holding cash. We are staring down geopolitical friction, global instability, and a fundamental physical scarcity crisis. The biggest fear for the short seller isn't a slow drift higher. It's waking up Monday morning to the Asian markets opening with a massive gap up because of a major development we couldn't predict. Our position is protected by the simple reality of supply, demand, and global volatility. While cash is naked and vulnerable to unpredictable global shocks, and while the robots are doing the heavy lifting, we must also monitor the external validation. We are waiting for the media pivot. Right now, mainstream coverage is still tentative, hesitant. They are still running stories asking, is this sustainable? That's the perfect sign that we are still early. When CNN and Bloomberg switch their focus from skepticism to running articles titled, "Why You Need to Own This Asset Now," that is the lagging indicator signaling the herd is entering. That is the final phase before euphoria takes hold. And we are right on the cusp of that narrative shift now that $65 has been secured. But the most potent mechanism in this whole automated process is the derivative trap. Every week, massive short positions puts are placed, betting the price will fall. When the price stays high and especially when it closes definitively above $65, those put sellers and short players face margin calls and the dreaded gamma squeeze scenario. They are forced to cover their short bets by buying the asset, creating guaranteed compulsory demand for the asset on Monday morning before any retail investor even wakes up. The current price isn't just attractive for buyers, it's an absolute wrecking ball for the short side. They cannot survive here. The demand we are expecting is not speculative, it is mandatory. This brings us away from the noise and the psychological warfare, and directly toward the map that dictates our route. We are done relying on fundamentals and rumors. We are now relying solely on cold, undeniable geometry. This brings us away from the noise and the psychological warfare, and directly toward the map that dictates our route. We are done relying on fundamentals and rumors. We are now relying solely on cold, undeniable geometry. When we talk about geometry, we are talking about the price pattern, the only true GPS in a world filled with conflicting narratives. This geometry isn't about hope, it's about mathematical physics. The price has moved, and now we must measure the potential energy released. For the macro perspective, zoom out and look at the chart, not just over the last 2 years, but over the last 4 decades. What you are seeing is the completion of one of the most powerful structures in technical analysis, the multi-decade cup and handle pattern. This pattern, built over 45 years of accumulation and suppression, signals the end of a long secular bear market and the beginning of a true supercycle. The mathematical target derived from the sheer depth and width of this formation projects the trajectory, all the way to $96. If $96 is the destination, we need the next gas station. We need the immediate roadmap. To find our next logical step, we turn to the most reliable predictive tool, Fibonacci extensions. This confirms the expectation of an explosive move. The engine is fired, the road is clear, and the automatic mechanism discussed in Act 2 is about to shift into high gear. Now, I need to address a trap that is guaranteed to ensnare the retail traders who are watching this. As the price surges, many analysts and indicators will start screaming sell, RSI is overbought. Let me stop you right there. The Relative Strength Index RSI is a great tool for choppy markets or quiet consolidation periods. It is an absolute psychological trap in a genuine supercycle breakout. When you see the RSI pinned high at 80 or 90 during a move of this magnitude, that is not a signal to sell. That is the speedometer telling you how fast you are going. High RSI, asterisk is asterisk the definition of velocity. Do not confuse speed for exhaustion. Selling because RSI is high is like selling a rocket ship because it's leaving the launch pad too quickly. We must also understand the function of psychological magnets. The big round numbers like the upcoming $70. Retail investors, or those focused on trivial profits, love to sell at $70 because it feels complete, tidy, and final. But for us, $70 is not a final resistance line. It's a asterisk fuel station asterisk. It is the point where the weaker hands sell their position to lock in a small gain, and where the institutional demand, the heavy money forced to cover their derivatives from the previous act, comes in and immediately absorbs that selling pressure. $70 serves as a brief, necessary consolidation point, where volume swells and velocity resets, before the push to the calculated target of $72 and beyond. We are not trading rumor, we are trading mathematical necessity. The market has given us the victory, securing $65.77 on the weekly close, positioning us perfectly for the assault on $72. This brings us to the most dangerous part of the entire journey, the emotional management of the 2-day pause. The emotional management of the 2-day pause. The weekly candle is closed. We secured $65.77. This is a tactical victory of the highest order because it locks the algorithmic trigger and neutralizes the institutional bear case for the immediate future. But victory brings its own unique danger. The temptation to tinker. We have moved the pieces onto the battlefield, and they are positioned perfectly. Now, the highest leverage decision you can make over the next 48 hours is to do nothing at all. The hardest thing to do when you are fundamentally right is to simply sit asterisk. Jesse Livermore called it the secret to all success in speculation, the ability to sit tight. The biggest threat to your portfolio this weekend is not global politics, it's your own hand hitting the sell button because you got spooked by a headline or convinced yourself you need to lock in a meager gain before the market reopens. You must accept the 2-day silence as the necessary consolidation of energy before the explosion. Your job this weekend is defense, specifically, the defense of your emotional capital. The institutional media knows the paper market has been beaten. They know the physical shortage is undeniable. So, what is their final play? They will try to manufacture fear, doubt, and panic. They will flood the zone with noise, inventing narratives about why this closing price is unsustainable. You must build a wall against that noise. If you own the position, do not check the prices. Do not read the articles written by those who missed the move. Disconnect. Protect your conviction. Because conviction is the only currency that will carry you through the early hours of Monday morning. When the market reopens, particularly as the Asian session begins, we must be ready for two scenarios, and our protocol is the same for both. Disciplined patience. Scenario 1, a gap up. This means the heavy capital flow the funds forced to cover their derivatives will enter immediately. If we see the price launch above $67 or $68 immediately, resist the urge to chase it. Wait for the retest. Every healthy parabola needs a brief consolidation, a retest of the breakout line. Wait for it to pull back to the previous resistance, now support, before adding any new allocation. Scenario 2, a gap down. This is the last desperate attempt by the trapped short sellers to shake out weak hands. If the price falls back towards $64, this is not a sign of failure. This is a gift. Watch how it reacts at that prior support level. If it holds, and if volume increases on the reversal, that is your opportunity to strengthen your position at the base of the breakout, before the major institutional firepower arrives. In either scenario, your primary instruction is, wait for confirmation, do not trade the open 5 minutes. Wait for the market to decide if it wants to continue the trend which the weekly close dictates it must, or briefly shake out the remaining retail interest. Remember the foundation of our entire thesis. We are no longer trading based on hope. Hope is the domain of the retail gambler. We are operating on certainty, dictated by mathematical necessity and the physics of supply and demand. The $1 trillion death spiral took 200 years to reach the point where the institutions could no longer control the paper price against the physical reality. And now, the pace of that vindication has accelerated, shifting the balance of power in just 90 days. The system failed. The manipulation failed. The algorithms have been triggered, and they do not care about your anxiety or your fear. They care only about the close above the mechanism line. We secured the line. The trajectory to the calculated target of $72 is set. $70 is merely the next gas station on the highway. We are moving from a state of sustained war to a state of sustained victory. Prepare for the push. We will reassess the geometry when we secure the next target. Be disciplined, be patient, and enjoy the silence, because the market is about to get very loud.